my pleasure to introduce the three speakers that we have. Just a housekeeping note, we will be taking a Q&A at the end. We're going to be starting off with a live discussion and then Q&A. You're free to enter your Q&A and questions using the dialogue in the Zoom window, and we will address as many questions during the live webinar and the Q&A session as we can. So starting us off today will be Dr. Richard Norris. Dr. Richard Norris has over 30 years oil and gas experience between industry and finance. He's currently managing director of Pendraco Energy Advisors, whose clients include IOCs, banks, asset managers, and policy centers. He writes and presents extensively on the relationship of energy, economics, society, and is a fellow of the Canadian Global Affairs Institute. Dr. Norris has a PhD in petroleum engineering from Imperial College in London. Also joining us today is our very own Manoj Narendra Madnani. Manoj is a global investor who strongly advocates the need for conscious and collaborative capitalism in all his ventures. He espouses the philosophy of 1 + 1 = 11, whereby his intended outcome is that every relationship must have an exponential impact for all parties. With a strong background on origination, corporate finance, international transactions, and corporate strategy, Manoj is an experienced board member with governance, value, and transparency. His track record includes high-level transactions that have allowed him to build extensive and impressive global network of contacts, and his performance in the oil and energy sector has been phenomenal. He's recently joined the Fritz Group as executive board member and is working closely with the founder, Florian Fritz, to take the Fritz Group to the next level. Part of that is through the efforts that he's undertaking at Sentinel Energy, which we're looking forward to sharing more with you about today. Manoj also was from 2007 to 2015, managing board member of Kolchak Investments, a very large family office and investment company. Mark Irwin, who's also joining us, is an experienced oil industry executive with over 25 years experience in the downstream oil sector. Starting in the UK as a cargo surveyor to managing a trading team at a refinery based in Libya, Mark has an extensive, broad knowledge of oil and trading markets. Having been based in Dubai since 2000, Mark returned to Dubai from Libya and was a key player in setting up a significant oil trading enterprise for a significant local investor, creating significant arbitrage business between the Middle East and Europe. Mark founded Sentinel in January 2019, along with Manoj, and has a BA in history and philosophy from UCLA. It's my sincere pleasure to be starting off our keynotes by Dr. Richard Norris. Dr. Norris, I'd love to hand over to you, and thank you so much for joining us today.
Thank you. I'll just share my screen. Hopefully everyone can see that. I'm going to dive right in. The first half of 2020 has been a succession of events that have created huge volatility in the oil markets, and this is also seeping across into the global gas markets. To see how the recent past has played out and to have a view on the future, we need to understand changes and indeed the lack of changes in the oil and gas arena. It's fashionable to say the oil industry is being disrupted, but in my view, it's very much business as usual, albeit somewhat shaken up. So to start very big picture, it's no surprise that the oil price is driven by the balance of supply and demand, which has been studied, dissected, and discussed for many years. But fundamentally, demand for oil has been increasing on a very linear trend for the last 40 years, as illustrated by the data in orange and the linear trend in purple on the slide. Even the great financial crisis of 2008-2009 barely made any impact. Now this global average, it masks an important subplot, which is that the OECD countries have already passed peak demand and have flat or declining oil demand. All of the growth in the last 10 years has been driven by the rise of Asia. And we will return to the demand side later with reference to COVID-19 and a post-COVID world, because this simple linear increase has been disrupted in recent months. On top of this simple supply-demand equation, there's the question of perception. When the world believes we have more oil than we need, or indeed more oil than we want, then minor events like cruise missile strikes on Saudi production facilities barely move the markets. This bizarre disinterest has been the reality for several years. However, the market has two modes, complacency and panic. And it's very conceivable that at some point in the next couple of years, we will flip to panic mode. in terms of volatility, it may well be a very bumpy ride. So if we drill down a little bit into more macro level detail, on the supply side, both oil and gas have undergone significant transformations through technological advances in the last couple of decades. Indeed, had we not had these advances, I think the world would look very different today. The most obvious one has been the unconventional or shale revolution in the US. It's salient to note that whilst oil demand has increased systematically every year, or at least in the pre-COVID-19 world, conventional oil production peaked in about 2005. The relative ease of working in shale has shifted focus from the long cycle deep water, high capex mega projects to short cycle, stay at home, reactive projects. Or at least that's the story we've been reading for a few years now. This shale bubble appears to be bursting in rather spectacular fashion at the moment, but it is unlikely to go away completely. The next iteration, which I'll call Shale 3.0, it will be different again, probably dominated by a few large, low cost of capital players, large independents and IOCs. And as one industry specialist has put it, when you think of unconventional oil, think of expensive oil. The US shale industry has destroyed a lot of capital, but whilst we need oil, we will continue to exploit non-conventional oil, as we do not have enough conventional supply. The implication of this is that the marginal barrel will become progressively more expensive. Indeed, the only reason we have not seen this in the last 5 to 10 years is because the marginal barrel was effectively being subsidized by the cheap capital, which is a subject I'll return to in a moment. The second globally significant technology was the development of liquefaction of gas, called liquefied natural gas, or LNG. And prior to the development of LNG technology, gas resources were only really of value if they're near to a market or within economic range by pipeline. That has changed significantly in the past 2 decades, and gas is shipped all over the world, opening commercial developments of gas resources that are far from any market and would have been considered as stranded previously. Equally, the ability to deliver this LNG via regas units opens many new markets. But the macro effects of these 2 technological advances is clear, particularly in the US, where the US transitioned from a decent but declining producer, where production fell to about 5 million barrels a day, to becoming the biggest producer in the world at over 12 million barrels a day, surpassing both Saudi Arabia and Russia in the end of 2019. Now, whilst that was all going on, there was a question of exports from the US, and it was a bit of a thorny issue. However, it was also a sideshow, and it was about getting the right grades of crude or blends to its refineries. And the reason it was a sideshow is because the US has always been a net importer of oil, even at the height of its shale production. So without shale oil and LNG, the world would already have an energy deficit. And it's worth remembering that these 2 fuels make up 60% of the world's primary energy supply. Or if we didn't have a deficit, at least we would have much more expensive oil and gas. Now, that statement might sound very odd, because gas prices in the US have been at or below break even for most producers for several years. And as the mainstream media gleefully announced in April, oil prices went badly negative. Well, low oil prices in the pre-COVID era were a function of oversupply, and the relatively minor oversupply that we saw at that time was massively disrupted by the demand side collapse, when a significant portion of the world's economy went into lockdown in Q1 and Q2 of this year. Unprecedented is a word that is overused, but I think here it's perhaps appropriate. Global demand collapsing by 20 to 30% is genuinely unprecedented. And I think we can note as an aside that the OPEC Plus, or Russia, Saudi Arabia, failure to agree a modest voluntary production cut in March, it was really a complete sideshow to the massive overprint of the effect of the COVID-19 pandemic. So when you have massive oversupply, you really only have 2 options: storage, and then subsequently stopping production. Shutting wells is not an exact science, but storage is exact and limited. So as tank tops approached everywhere, everyone knew that oil production had to be curtailed, but of course nobody wanted to be the first to do so. But when there is physically nowhere to put the oil, there is no option other than reducing flow, or in worst cases, halting production. Now, on top of this disruption in the physical area, it was further distorted by huge ETFs, or exchange traded funds, that bought and rolled short-term future contracts, which allowed retail investors direct exposure to the oil price. An unfortunate aspect of the contracts being used was that the ETFs were on the hook to physically take possession of large volumes of crude without actually having any logistical or storage capacity. So rather like in the mechanics of a short squeeze on equities, where positions have to be closed out at any price, the price discovery here was as brutal as it was short-lived. And it's worth remembering that this was a point in time, it was quite specific to WTI, and rebalancing globally is already underway, with oil having priced over $40 last week. Now, when we talk about rebalancing, we need to think of it both being voluntary, as in the production cuts we've seen from OPEC and OPEC Plus, and involuntary, such as economic and storage-driven cuts from the US. The collapse of the rig count is well known in the US. The number of wells being shut in is not well known, but it's certainly happening. Globally, oil companies have been very quick to slash investments. More worryingly, low oil prices negatively affect the national budgets of producing states. And we should note that producing states represent about 85% of global production. The IOC is only about 15%. Many of these states have significant cash reserves to help weather these periods. Many do not. And in the latter case, unpaid wages across the national industry, the civil service and the police and army will rapidly lead to production curtailments. So putting this all together would indicate there's an immense damage being done to an industry that's not yet recovered from the 2014 price collapse. It is highly likely that supply will not pick up quickly when the world requires more oil, and there will be a supply shortfall. The next flush of production will require a significant price trigger, and whilst that is music to the ears of radical environmentalists, it should be of great concern to economists and politicians. High oil prices trigger recessions, and any recession in the next few years will be very bad news in a world that's saddled with massive COVID-19 related debt. So returning to the demand side, there was much talk in the pre-COVID era about peak demand as the energy transition bites. Indeed, the death of the oil industry has been widely reported. Now, in my view, there are two problems with this narrative. The short-term oversupply of 2014 to 2020 was driven by huge amounts of quantitative easing capital looking for a home in a world of zero interest rates. And secondly, the arrival of peak demand will not be a cliff edge, but a continuing need actually for a large amount of oil. Taking these points in order, the effect of large amounts of capital being pumped into a system distorts a market. I think the current dislocation between Wall Street and Main Street can only be explained by the market believing that the COVID stimulus dollars make the valuations justified. Likewise, the ability to lose money year after year allowed shale drillers to produce lots of oil, creating an artificially low pricing for the marginal barrel. The current even bigger fiscal stimulus, however, is unlikely to follow suit. I believe too much money has been lost in the smoke and mirrors of shale for it to be repeated. The second part that I think is wrong is the question of peak demand. Now, peak demand certainly will happen, but as I noted just now, it will not be a cliff edge. If one takes a rapid transition scenario, which is the orange line in this graph, and it's more aggressive than the stated policies or even the pledges for the Paris Accord transition scenarios. That is, if everything goes better than the currently planned transition, the world will still require roughly 700 billion barrels in the next 20 years. What this graph shows is that the first 700 million barrels took about 100 years to produce. The second 700 million barrels, taking us up to 2020, occurred in the last 20 years. And even in the rapid decline scenario, the next 20 years will require another 700 billion barrels, very round figures. That is almost 50% of the total production of oil that the world has used in the entire 150-year history. And that's going to happen in the next 2 decades. And to make this worse, and it's a bit geeky here, but a big chunk of today's production actually comes from declining or fast declining supergiant and giant fields, which were discovered in the 1930s, 40s, 50s, and 60s. These fields are maturing and fading. In almost all the forecasts pre-COVID, the US shale was the fudge factor that was used to plug the gap between declining conventional production plus the known new development projects and the forecast demand growth. Now, COVID-19 may change people's behavior with more video conferencing like this one, less gratuitous business travel, and so on. But fundamentally, I don't see a new normal in which everyone sits in their gardens enjoying the birdsong. Now, that vision may be great for the comfortably woke, but there are 40 million newly minted unemployed in the US who want to get back to work. And ironically, for all of the angst about how COVID-19 will change the world demand may well come back more strongly than supply can match. Shale should help meet demand, but not at $50 a barrel. What I see is a major supply side shock in the near to midterm, and consequent higher prices and potential for economic turmoil. However this plays out, it will certainly not be as anyone predicts, but it is very likely to be bumpy. And with that, I will now hand back to Zach for the main event.
Excellent, very enlightening discussion. Just to touch upon the final points that you highlighted. So you're seeing a potential supply side shock coming to the market, ostensibly driven by disruption of CapEx. So should we expect a $70 per barrel oil price? If so, when do you see that potentially happening? What can we expect on the ride? Is it going to continue to be a bumpy ride?
I think if I knew the answer to that, we probably wouldn't need to have any kind of algorithmic trading. The trouble with the oil prices is you can be right about the fundamentals and about the direction, but you can be very wrong about the timing, or you can be right about the timing and wrong about the price. So I would not be in a position to try and say when we will see higher oil prices. I just think that fundamentally we are seeing such disruption in the industry, with the cost of capital being pushed up as banks and funding institutions pull out, as the energy transition moves ahead. There's a lot of uncertainties. So I'm not going to start making price predictions, I'm afraid.
Well, that's perfect, actually, because that helps me better understand the approach we're taking here. So for an algorithm, well, any energy expert can cannot claim to have a crystal ball and say what the outlook is for the price of oil. Algorithmic trading strategies have been able to take advantage of systematic inefficiencies. And this is where, Manoj, I've seen you are making considerable investment. If you don't mind telling me a little bit more about this and the investment that you've been making into this algorithmic program.
Thank you, Zach. Firstly, I'm going to thank you, Zach, for that kind introduction. And Richard, I want to thank you for the valuable insights that you shared. Before I jump into that specific question, Zach, I'm going to share with everyone the underlying thesis behind the drive into creating Sentinel. So it has been a very interesting few months, and what we have seen is that the level of volatility in the energy markets is providing exciting opportunities. And I want to thank you all today for taking the time to be here. We're here to talk about the Sentinel Energy Alpha Fund, and I wanted to share the reasons why the Fritz Group and the DSA Group had invested in the management and the underlying thesis behind this. We've had extreme amounts of volatility over the last 15 years in the energy sector, and Richard's presentation highlighted that. I was able to monetize the growth previously by investing heavily in the upstream sector, whilst I was at Colchick Investments from 2007 to 2015, where we effectively invested pennies to make dollars. Whilst demand for energy is directly linked to demographic growth, what was becoming clearly evident was that as demand grew, this was becoming a sector dominated by the big balance sheet international oil companies, the national oil companies, and the emergence of the global traders, Glencore, Vitol, Trafigura, Mercuria, to name a few of them, whereby effectively you are now risking dollars to make pennies in a highly volatile environment. So this forced me to look at investing in the energy sector in a very different manner. I spent a lot of time, I sat on the board of an AI company in the US, and I understood the impact of AI, of artificial intelligence and machine learning, industry tech in the energy sector. And I was actively looking for innovative ways to remain relevant in the sector. I think you've heard enough from me, and I think it's time for you to hear the value creation thesis from Mark and Adam. Should any of you have any questions, you know where to reach me, and thank you very much for your time.
Well, thank you, Manoj, and congratulations on what is a significant investment into seeding this program. Again, I understand that the performance has been quite positive, and I was hoping, Mark, that you might be able to take us through that, because again, the focus of this webinar and session is profiting on volatility. So we basically come to understand, okay, energy sector, we have significant volatility. It's not going away anytime soon. It is impossible for anyone to with any significant degree of confidence predict the outcome of the price of oil 6, 12 months, several years out, given what's been happening in the market. So how can you profit on volatility? How can a strategy extract inefficiencies that are durable in energy markets and that persist across various market cycles?
As Manoj has already said, Sentinel Commodities was established in 2019, and we are an independent proprietary trading company. We specialize in the energy derivative space and have a team of market makers and a team of options traders. We also run bespoke risk management consultancies for large industrials, regional airlines, and even other oil trading companies. We have a wealth of experience across the organization, from upstream, midstream, downstream, and especially in the derivatives energy sector. As Manoj has already introduced the board, I thought it might be relevant to just give them a photo to explain who everybody is. I'd like to echo Manoj's sentiments with regards to the recent addition to our organization of the Fritz Group. We're extremely excited about our relationship with them and how they can help us on our journey forwards. The core Sentinel advisory team is myself and Adam, has already been excited. Adam is a market maker who is focused primarily in the light end sector. He has been very keen to develop his skills in researching, coding, and programming, and has been given the time and the resources by Sentinel to deploy those skills. Anand joined us from Credit Suisse in Singapore, where he ran the exotic options and equity derivatives desks and spent time with BlackRock. And Natalia has a wealth of finance experience in both physical and the energy derivatives markets. No presentation would be complete these days without an acknowledgement to the volatile times we find ourselves in. COVID-19 has taken a sledgehammer to global economies. Rightly, governments have put financial stimulus packages into play, but we still don't know the full economic consequences of COVID-19. We also don't know the economic consequences of the financial stimulus measures that have been put in place. As we all know, in this particular part of the world, the regional economy is very, very dependent on crude oil prices for infrastructure spending and for the budgets. The low oil prices has created a severe economic impact on these regional economies, exacerbated by COVID-19. Prior to COVID, we were in a period of geopolitical tensions, trade wars, and let's not forget Brexit, which has been wiped off the front pages for the time being by COVID. So it's very clear that ahead of us are a number of volatile times and a number of volatile experiences. What will be the new normal post-COVID? Nobody quite knows, but what is certain is that there will be volatile times ahead, and this will create opportunities for us. When I talk about the derivatives market, I'm talking purely about futures, swaps, and vanilla options in the oil markets, which relate to the underlying physical crude and refined products that are traded on a global basis day by day. To give us an idea of the size of that market, real estate, which is considered to be one of the largest asset classes, is around about 280 trillion in notional value. But global derivatives across all asset classes is really between 600 trillion and a quadrillion in notional value, with 600 trillion being OTC markets and the verifiable, and a quadrillion being the high-end estimate of private and bilateral arrangements. As participants in the energy derivatives market ourselves, we see a constantly evolving landscape. As we know, that ADNOC and ICE have entered a joint venture to develop a new Murban crude benchmark based down in Abu Dhabi, and ICE will be opening a floor in the ADGM. This will compete with the DME to be a regional benchmark for this region. We've seen very increased activity in the JKM LNG market, as what was previously a market dominated by upstream utility buyers and large major league producers is now more open to traders, and As a result, the increased need for hedging and futures markets. Conversely, we've seen a decrease in the fuel oil derivatives market as IMO 2020 led legislation to bring in cleaner bunker fuels. And now, as a result, bunker fuel is now tended to trade on gas oil related pricing rather than the fuel oil derivatives. As a regional development, we've also seen Aramco and ADNOC take a much more sophisticated approach to their buying practices. They recently moved from being price takers to price makers. They have teams of traders based in Riyadh, Abu Dhabi and Fujairah, and they are now much more engaged in the derivative markets. This is a very exciting development for us as they come into the market with their hedging programs. And at the bottom of this slide, you can see the market participants. This is just a few household names who participate in the energy derivative space. This is by far exhaustive, and there's an extensive list of players who participate on a daily basis across the energy spectrum. Just a very simple chart to show the volatility over the last 13 years. The green line is the S&P VIX index, which looks at the front month option. And as you can see, overlaying over that is the OVX, or which is the US oil ETF option, which has until very recently tended to follow the front month. As you can see, there's a reasonable correlation. Even in 08-09, during the financial crisis, they tended to trend together, and they follow each other through to 15-16, when there's a slight delineation. But as you can see, as everybody was talking about March and April, there was a complete disconnection between the volatility index of the oil ETF and the VIX. This is an extremely severe disconnection between those. To drill down into slightly further detail, as you can see, over the last 21 years, WTI has tended to trade not more than 10%, around 99% of the time. However, on 9 occasions between March the 9th and April the 29th this year, you can see a significant departure from that range-bound trade, exacerbated on the 20th of April with a disconnection of 305%, when everybody was wondering why on earth TI went negative. I'd like to thank you very much for your time today. If you have any further details, please contact Demetrius here at Dalma. And at this point, I'd like to hand back to Zach.
Excellent, thank you. So I mean, from an investor's perspective, we all know that, you know, one of the sayings that we have in the hedge fund industry is you're not really investing in hedge funds, you're investing in hedge funds, right? In order to generate alpha, there needs to be some kind of inefficiency in the market. By definition, markets don't give free alpha. So what's the edge that you and the team are exploiting? How are you extracting alpha in this market? How are you taking advantage of those inefficiencies?
Thank you for that, Zach. I think at this point, I'll probably hand over to Adam and introduce him, and he can explain to you how we're developing that.
Thank you, Mark. With regards to edge that we have in the market, our market, as shown by Mark, is massively influenced by very large physical trading counterparts, whether they IOCs, NOCs, or physical trading houses based in Geneva, Switzerland. We find that a lot of these counterparts are just looking to hedge physical flows. That means that there is edge in the market because they are not overly concerned with the short-term distortions, but looking to provide return to shareholders on a risk-adjusted basis. We think that the edge will continue because we haven't seen any degradation in the edge over the whole time since the derivatives market has become centrally cleared and the derivatives market has grown substantially. If you were to look at the underlying utility of a commercial, they have a very different utility function for hedging than we do as speculative capital looking to capture these many diversified edges. So if we were a big physical player, we would still pay those edges to the likes of us who benefit from capturing those diversified small edges. So the total hedging environment is somewhat symbiotic in that we capture risks that other people don't want to have, and they get to offload the risks that they don't want to have. I hope that answers the question.
Excellent. Well, I'd love to be able to spend more time on it. Again, I think that there are a lot of points that we didn't get to touch upon, but we are out of time. So I just wanted to thank you, Adam, Mark, Dr. Norris, for your presentation, and offer a congratulations to Manoj for investing in this program. Again, we're very excited from our part to be being able to play a role and be at the at the ground floor of this product. I'd love to anyone who's joined the session and is interested to learn more. Again, we did put out a webinar. If you have any other Q&A on the webinar, if you have any other questions, we'd love to follow up with you. We'd love to tell you more about the strategy and about some of the sub-strategies. Again, we do have future webinars planned as well. So on the few days from now, on the 10th, we have Is This the Time for Bitcoin? We have Mike Novogratz, the billionaire founder of Galaxy Digital and ex-president of Fortress Investments, as well as the CEO and founder of one of the largest Bitcoin and crypto funds in the world, Pantera Capital, that are going to be joining us. So please be sure to tune into that session. But again, a big thank you to Mark, to Adam, to Dr. Richard, and a huge congratulations to Manoj. Thank you very much for leading this session and telling us a little bit about what's happening in the oil markets and how to profit from the inefficiency in those markets.